Wall Street used to be dominated by slick-haired dealmakers, coke-fueled stockbrokers, and finance bros draped in Patagonia vests with trust funds. But today, it's a different world. Today, it's ruled by nerds. Literal nerds. We're talking about the kind of geeks who got straight A's in their math and computer science classes, the ones who could solve Rubik's Cubes in under a minute and give you a detailed explanation of Fourier transforms in their sleep. These are the people who, in a world that used to value smooth talkers and charm, are now the kings of finance. These quants, or quantitative analysts, are the modern-day financial wizards. They don't trade stocks like you, or I might imagine. No, these guys don't just guess based on gut feeling. They write algorithms, create formulas, and run simulations that predict the movements of the market with a level of precision that most people could never even fathom. They use Python, C++, and advanced statistical models to predict financial outcomes, and their job is to turn math into money. But let's be real here. How did they get so damn good at it? How did these socially awkward, possibly neurodivergent individuals manage to crack the code of wealth creation that most of us are still trying to figure out? Well, buckle up, because I'm about to break it down for you. A quant is someone who uses advanced math, statistics, and computer science to predict, trade, and sometimes manipulate financial markets for profit. They're like the engineers of Wall Street, and the products they build are often algorithms that trade billions of dollars daily. But don't let their awkward social skills fool you. These guys aren't just nerds who got lucky with a couple of good trades. They're the result of years of education, training, and a willingness to dive into a complex world that most of us just wouldn't have the patience for. Quants make up the backbone of some of the most profitable hedge funds and financial institutions in the world. Firms like Renaissance Technologies, Two Sigma, and Citadel are all built on the backs of these mathematical prodigies. The best part? These guys are making insane amounts of money doing it. Fresh graduates who enter top quant firms can earn between $200,000 and $400,000 straight out of university. And that's just the starting point. The real money comes in the form of bonuses. If their algorithms are making bank, they're getting cut, sometimes a hefty one. But how exactly does all this work? How does someone go from being a socially awkward mathlete to a billionaire? Let's break it down. First, let's talk about the types of quants. There are three primary types: quantitative researchers, quantitative developers, and quantitative traders. And while they all share a love of math and a general sense of detachment from social norms, each plays a different role in the quant world. Quantitative researchers are the creative geniuses behind the scenes. They come up with the theories, the models, and the ideas that shape how their firms will trade. They might use satellite images of car parks to predict Walmart's earnings, or track the sale of cardboard boxes to figure out how many deliveries FedEx will make. They hypothesize, they test, and they backtest their theories using historical data. Backtesting is a critical part of a quant's job. It's a process where they test their trading algorithms against historical market data to see if they would have worked in the past. If they do, great. If not, back to the drawing board. This is a never-ending cycle. And just like a scientist, a quantitative researcher's job is never done. Once the quantitative researcher has developed a successful model, the next step is handing it off to a quantitative developer. The developer is the one who turns the ideas into reality. They take the theoretical models and make them work in the real world, turning ideas into live, working algorithms that can trade billions of dollars in the blink of an eye. They also have to make sure the algorithms are fast enough to compete in a high-frequency trading environment, where every microsecond counts. Now, this is where things get tricky. The developer's job is to ensure the algorithm works as efficiently as possible, while still being scalable enough to handle the enormous volumes of data that a top-tier hedge fund needs to process. They write the code that runs these models, and they do it with an intensity that can only come from someone who understands the importance of every single line of code they write. But the job doesn't end there. Once the algorithm is live, it's time for the quant traders to step in. The quant trader is the person who monitors the models in real time and intervenes when things go wrong. They make sure the algorithms are functioning properly and react to market conditions as needed. And this is where things get interesting. You see, the markets are unpredictable. A company could announce a scandal, or the Fed could raise interest rates, and that could cause chaos in the market. So, while the algorithms are great at predicting patterns, the traders are the ones who have to deal with those unpredictable moments. So, how do these quants make money? The same way any other trader does, by buying low and selling high. But the difference is that quants don't rely on emotions or gut feelings. They rely on math and data. And when they find an inefficiency in the market, they exploit it faster than anyone else. Let's talk about a few examples to show how quants make money. Take Jim Simons, for instance. He's a former mathematician and the founder of Renaissance Technologies, one of the most successful hedge funds in history. Simons is considered one of the pioneers of quantitative finance, and his firm has earned average annual returns of over 35% for the last 3 decades. His Medallion Fund, in particular, is considered the most successful hedge fund of all time. But Jim Simons didn't get to where he is today by just making a couple of lucky guesses. He spent years developing complex algorithms, testing them against historical data, and refining them to perfection. And the results speak for themselves. Then there's George Soros, another legendary figure in the quant world. In 1992, Soros made $1 billion in a single trade by betting against the British pound. He famously broke the Bank of England by predicting that the UK would be forced to devalue its currency. Soros made his fortune by identifying inefficiencies in the market and exploiting them. These two men didn't get rich by chance. They got rich because they understood the markets better than anyone else, and they had the tools to exploit that knowledge. But not all quants are as successful as Simons or Soros. In fact, many quants lose money. The key to success in this field is developing a model that works consistently over time. But even the best models can fail when unexpected events happen, like the 2008 financial crisis or the COVID-19 pandemic. That's why quant trading is so high risk. It's not for the faint of heart. So, how do you become a quant? Well, the path is not easy. Most quants have advanced degrees in mathematics, computer science, or physics. Many come from top universities, and they've spent years honing their skills before they ever enter the world of high finance. But if you're looking to break into the world of quantitative finance, there are a few things you can do. First, you need to learn the fundamentals of math and programming. You need to be able to understand complex mathematical concepts like linear algebra, probability, and calculus. And you need to know how to use programming languages like Python, C++, and are to turn those mathematical concepts into live trading algorithms. Once you have a solid foundation, it's time to start building. Build your own models, test them, and refine them. Enter coding competitions like Kaggle or Quant Connect, where you can compete with other aspiring quants to create the best models. And most importantly, learn from your mistakes. Because in this field, failure is just another step towards success. But don't expect to walk into a top hedge fund right out of college. The path to success in this field is long, and it's filled with obstacles. You need experience, you need connections, and you need to be willing to put in the work. But if you're willing to grind it out, the rewards can be massive. As for the future of quantitative finance, it's clear that technology will continue to play an increasingly important role. With the rise of machine learning, artificial intelligence, and big data, quants have more tools than ever to make money in the markets. But at the same time, the competition is getting tougher. More and more people are entering the field, and the algorithms they're developing are becoming more sophisticated. The future of quants will likely involve even more automation and artificial intelligence. It's already happening. Many top hedge funds are using AI to build and optimize their trading algorithms. And as the technology continues to evolve, it's possible that we'll see more AI quants replacing human traders altogether. But one thing is certain, the world of quantitative finance is here to stay. It's a high-risk, high-reward game. And if you can crack the code, the rewards are enormous. So, if you're looking to make a career in this field, remember, it's not enough to just be good at math. You need to be able to turn that math into money. So, are you ready to dive into the world of quants? Because if you are, the market is waiting for you.